Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone as usual. What a slow and strange kind of languishing day here. And we're going to get to the charts really quickly. First, show a few disclosures. We have added some other disclosures into the chat if you want to check those out. As usual, if you want to go to tradestation.com, click on Insights at the top of the main page. It will take you to our blog. At the top, we have an article which has the main items that we're going to be talking about today. It's actually pretty interesting. I was kind of stunned when I really looked at it and saw. So you go to Trade Decision, go to Insights, and there you go. So basically, into some ETFs because we might talk about those. So I wanted to show that to you quickly. These are some ETFs that we might talk about, and hopefully there we go. All right. You know, my window's updated. It probably happened to other people, and I'm some things are moving a little bit more slowly, and I hope that doesn't last forever, but we're trying to let you know about that. All right, now here's the ETFs. Now let's take a look here. Let's go here to this is my article. Tesla fades as Chinese EV stocks jump. I really couldn't believe this because these Chinese names have really been moving. Now we were talking about this more than a month ago, and it's been more or less panning out. So I think that's interesting. But first, look at the overall market here because we got to really kind of I think hone into some of these kind of key points on the S&P 500 right now. This is our MTES. Now remember, at the top of this blog post, you can go here and get downloads. And basically, if you go and you install the ELD files, it's a zip, and an ELD files has the actual TradeStation indicators in it. And once you have those loaded, you can open these workspaces. MTES is one that I like to look at, and basically this is one that uses uses hourly of the cash index and hourly of the futures. So basically what we see here, this is the hourly, and there's a level here that goes back to the last Friday of last year after of Christmas week, back here on the 27th. If you look, it was right around here. And basically this closed right around here, which I'm marking with my mouse. I have it on the other one I'm going to show you, is you can see we bounced at it here. This was a deep seek day. This was a tariff day. So we held and rallied both times. This was when there was a hot CPI report and we dropped and we went to a new high and we failed. So last webinar, we were right here and we said there was a risk of us getting sucked back down. And we said if we did not hold 6101 and we didn't, and we got sucked back into the range. And now the thing that's potentially tricky here is the fact that these levels we bounced at, we're now potentially consolidating below them. And that is a potential risk here. So we look on this chart. This doesn't really tell us a whole lot of anything right now. The main signal would be modestly bearish with the 50-hour moving average falling and the MACD falling. However, stochastics are oversold. So at this moment, it wouldn't give much of a clear kind of setup. And the other thing is that the PCE report is in the morning. So you have a little bit of a risk of maybe some, if we don't get some sell off, then you get potential short squeezing into the close. And sometimes, if you think there's going to be more of a push to the downside, a lot of other people are thinking that too, and it has a way of turning into short squeezes when the drop doesn't happen. So that's on the short term, like kind of hourly chart. On the daily chart, though, there's a lot of things here. Now, last week we had talked about how things like MACD and RSI and rate of change were looking positive, but the fact is that they were vaguely, bullish last week. And essentially, this did turn into a false breakout. And from my perspective now, the market has entered a period now where it is in a much more, potentially kind of environment that could see some downside. And one of the reasons is this is the level, this is that same Friday after Christmas, the last Friday of 2024. And you can see that it was a support, and now we're trying to cling to it, but we're not really doing a whole lot. So I think that's important to realize. Now, if you look at some other indicators, you can see that RSI is inching down toward like 40 now. And I think that's kind of like also something to realize is that, it hasn't really exploded to the downside, and this is to see these indicators inching lower, it does reflect here some real weakening of the momentum, still pretty close to the highs. This shows the speed of the 50-day moving average, and you can show that, see, that's also now pushing lower. So there's some different indicators here that suggest that the momentum is getting weak. We're trying to hold support and potentially not doing it. Now, when we did our state of the market on Monday, we had said that this was an important level, and it has proven to be an important level. And we basically said that people might worry that if we really get below it, that a move to 5,800 could be in the cards. So I think that's something I want to focus on here. And with the PCE coming tomorrow, I think that's also something here that we have to kind of have on our radar. We actually we undercut that low and went all the way back. This low, basically on Tuesday, was the lowest low since the middle of January. So on the weekly chart, you can also say that we've potentially seen some kind of damage. We can look over here. I have a weekly chart on this workspace. And I think it's interesting when you see what an uptrend, when things are in a tight bullish uptrend, you tend to see different sort of behavior on the weekly chart. You don't see things like scraping down to those kind of levels. So if you look, there's a weekly, the S&P here, but if you look on this chart, when things are in tighter uptrends, the lows are kind of a 1 to 2 week low. This was a 7 week low that we made on Tuesday. If you look here, this is the lowest. That's the weekly now. So this low, the bottom. So the fact that we even kind of went down there, and even if we've rebounded, the week is not done yet. So that creates some potential, kind of suggestion that we're starting to nibble those lows. People are trying to go there. They're not really ready to break it yet, but there is a sort of degree of an increasing amount of weakness here. And I think it's important to realize that we really have had these kind of failed breakouts. If you look here from December 6th to where we were in late January, we barely went higher by like less than 1%, and then kind of, or maybe barely 1%, and then we lost it. Then we went a tiny bit higher a few weeks later, and we lost it. And here we are back to where we were, before Thanksgiving. So I think this is something where, there are some real signs here of this, giving some potential topping. And so I think this, um, the market tries to tell us things, and this is maybe something here that we need to pay attention to. If we look at our MT breadth, we can also see, well, actually, I'm going to go to MT main, and I'm going to look at the key ETFs, because we're also seeing a sort of degradation to a certain extent of the sector performance. We are seeing over here on our key ETFs, if we look, see, Microsoft is, this Windows is slower now. In the last month, our leadership is coming from, consumer staples and real estate, the two biggest sectors. Well, I'm not sure if it's the biggest, but technology is by far the biggest. It's lagging. Consumer discretionaries, which is Tesla, lagging. So you can see we have a little bit of outperformance in XLC. That's our other, kind of friend in terms of the mega cap trio, which is XLY, XLK, XLC. That's just barely outperforming the last month. And we have, strength in things like financials that are doing well today. But, I'll tell you, that is the way the market looked in late 2021, early 2022. We did see the value names doing well. And given the fact that growth does remain such a dominant part of the market, when you see value doing well, when you see these other areas doing well, that is not a sign of the market being strong. It's a sign of money is still trickling in, and it's not going to leadership. It's just kind of trickling into whatever's easy for now. And sometimes what you'll see is it just kind of drifts like that. And then that actually suggests that the internals are weakening. I believe that sector performance, and I have found, is a more useful form of market internals than traditional advanced decline lines. Because the problem with advanced decline line and things like that and participation is you'll get like, 100 like small companies that are going up that just don't matter. And so I want to point out that the sector performance, in my view, this is what it looked like at other times, like in late 21, when you would see that the Nasdaq. We were writing articles at the time talking about the weakness in large caps, weakness in growth, weakness in the Nasdaq, and so this is the patterns are similar, the behavior is similar. So let's see. I mentioned PCE tomorrow is a huge thing. Now we do have our schedule here at the bottom, things to kind of look out for. PCE tomorrow, and then next week we get our monthly data. Now the data, before we get to Tesla, this is pretty interesting. I do want to mention that the data, really has been showing, and Mohammed Al Arian tweeted today about how we're seeing a stagflationary environment, and I think that that is something that has been kind of coming into play here. Jobless claims today were higher than people expected, despite the fact that it doesn't seem to have been government workers allegedly getting laid off by Doge. Now, I would just suggest when you look at the data we've had in the last 10 days or so, calendar days, you will see NAHB, maybe it was a little more than that, but the NAHB building report was very negative. They said that people want to build fewer houses and they're going to raise prices. So basically, what you're probably going to see is the builders are going to build high-end homes and they can have high margin, and then they're not going to be delivering those, other kinds of lower end houses or anything like that. But again, that is not what you want to see if you want to see inflation data come down. We saw some of the different numbers out there. So, for example, there was a housing number that showed home prices continuing to go higher even as sales go down. I've got my data on another screen. I don't remember. I'm sorry. Let me just really quickly pull up another thing where I can see that. But that is not also very good. Today's GDP report showed weaker consumption and private investment, higher prices. Durable goods had a huge bump from Boeing going back online, but the overall number missed. So we're in an environment here where I think if we look out into the future and we look at the commentary that was coming from consumer sentiment, consumer confidence, PMI, and then we look at the PMI from S&P. We look at the the home builder sentiment thing looking forward from the home builders. Those things suggest that we're going to see less business activity. Now, suddenly, lo and behold, jobless claims jump to a 3-month high, way more than people expect, and it doesn't seem to be the Doge effect. So we need to kind of be on guard here for the potential that we're going to start to see the loss of construction jobs and cyclical jobs, and that might really be the leading thing that we're starting to see here. The data is not there yet. I want to point that out because the data in terms of things like building and stuff, if you're doing some project and suddenly all your plywood is going to cost 25, 30% more, or your different things are more, or whatever is happening, there's a chance here of business and projects getting delayed, and what that actually does to hiring, aggregate demand, and everything else. So there's a reason why yields have been coming down. The thing Al Arian said was interesting, and this environment is more stagflationary here, and I think that is here it is. General existing and new home sales misestimates. The median new home price rose 7.5% month over month. So that was the thing I was talking about. Now, we also see here in the Dallas Fed, new orders outlook capacity utilization drop as costs rise. That was kind of interesting. With the consumer sentiment we mentioned here. All these data points, I'm trying to remember when they all kind of come through. But what's interesting is that today we actually saw, his name is Jeffrey Schmidt. He's a new guy at the Kansas City Fed. He was basically saying inflation is firm and sticky, and I'm more cautious about cutting rates than I was, the last time he gave a speech in January. So also Steve Lees from the CNBC kind of did a little video report last week, and he basically said Fed officials are really making a point that they don't want to cut interest rates until inflation goes lower. So you know what? They're not going to come out and bash Trump for tariffs, but they are going to say, where you want to see inflation come down before we cut rates. They're not going to go head on, but they're going to basically say it that way. So I think it's important to realize here is that any kind of hope here of the dovish expectation is fading. At the same time, the cyclical dynamic is weakening, and that is stagflation. Or at least it is stagflationary. So let me just say that. I'm going to say that it's full-blown stagflation or anything like that. But you can see the pieces coming together here, and you can also kind of see potentially how the narrative can unfold of uncertainty resulting in delayed business, resulting in less employment, resulting in other sorts of economic weakness, resulting in less consumption, all those things, one thing tying into another, and that can result in potentially weaker economic growth. At the same time, inflation stays high, and you can also see built into the numbers that prices not coming down. We saw it today also with, like I said, the PCE component of the GDP, prices not coming down. Now, my expectation coming into the year that we were going to see basically the base effect in shelter cost trickle through and drag down overall CPI. The ingredients for that are present, but the different sort of policy things are not really letting that natural process of disinflation play out. And I think that's what the market is starting to see. So we got a number today from the American Association of Individual Investors. It was under 20% bullish. It was the most negative. All right, it was 19.3% bullish, the American Association of Individual Investors weekly survey, the lowest since March 2023 when we had that mini bank run over the Silicon Valley Bank. After that, you have to go back to September of 2022 to find a time when sentiment was this negative. The bearish is the highest since also September 2022, over 60% in the AAII. Now that comes out this morning, so I didn't put it in my article, which I did last night. But the key thing is that the market sees this. A lot of people see this. So one of the things here that's remains something of a positive in a way is the fact that sentiment is extremely negative here, and there's probably not a huge amount of leverage money going in the market, which reduces the ability for a violent unwind. However, I think the real thing we have to focus on is valuations, because with trading at 20 times earnings, you can't afford to see earnings growth go from 12% to 8%. Then people say the valuations don't make sense. And we've seen some evidence of the growth in S&P earnings getting nudged into future quarters. If you look at, for example, NVIDIA, the guidance, margins, not great. Now, margins are often the canary in the coal mine that will tell you first what's really happening. Some other things today. Norwegian Cruise Lines said their passengers dropped a certain, unexpectedly, and it kind of worried people. Pure Storage, another tech company, I'll show it to you, PSTG. Let's see. I just hope this Windows doesn't hurt me too bad here. PSTG had also margin guidance. Margins often tell you first what's really happening in terms of business. And I want to point that out. So we're seeing margins from NVIDIA, margins from Pure Storage. So that's those are things I wanted to kind of note here. I'm looking at some other notes to see if there's anything else. Goldman Sachs got downgraded by KBW on a lack of deal making. Salesforce.com basically has not shown traction in the AI agents. And I think that's also something to be aware of that is kind of, a potential worry also. Salesforce.com is this company that has been a dynamic leader for the last 2 decades in terms of establishing itself in enterprise and kind of, if a company is going to succeed in launching things like AI agents and pushing it into the mainstream for corporate use, in some ways, Salesforce, maybe ServiceNow, I mean, these are the companies that have successfully done this well. So to see Salesforce come through and miss like this, again, that might, to a certain extent, undermine this idea of AI and the just infinite growth that we think it's going to have in the future. So again, if you're trading at 20 times earnings and you start shaving off percentage points of earnings growth to the S&P 500, that creates potential problems. And I think that's kind of the world we're in right now. You can feel the negativity and the worries building, and we're waiting for something to confirm it, or we're waiting for something to say, it's not going to be that bad. That's where we're sitting right now. And I think we have to recognize what those dynamics are. We have to recognize that sentiment has gotten extremely bearish. There's a lot of awareness of these things. I'm not the only person saying stagflation and things like that. And I think that, it was interesting to see that spike in jobless claims without it coming from government workers. And so, like I said, I think it'd be interesting to see when we get to a week from tomorrow, 8 days from now, when we get those payroll numbers, what is the construction line going to look like? The construction workers and things like that that could be exposed. And I think that to me is what I'm really looking at to see if this tariff policy turns into loss of construction jobs and what that could mean overall for the economy, for aggregate demand, for sentiment, everything like that. So let's look now at some of the other things in my article. I'm going to just quickly point out. There's a lot of these. This is an executive at Home Depot saying higher rates are hurting the remodeling. There's a lot of people here warning on these things on AI revenue. A gentleman, a professor at NYU. These are just things I see when I'm always reviewing the news. But I'm seeing more of a sort of like coherent negativity. There's always people out there saying the world's about to end. There's this crash that's coming tomorrow. That's always there. But this is a more kind of credible, I don't want to say credible, but it's more plausible. It's more connected to reality than your normal stuff when you just like, go on, different websites and things online and you see things of people just predicting there's going to be a banking crisis tomorrow. That is always out there. And it's usually, not worth paying attention to. But some of the things I've seen more recently seem to make a little more sense. When you have a guy at NYU saying AI revenue isn't there, and then you say Salesforce with the agents not performing well, and you see these reports that maybe Microsoft is trimming their capex. All these are their whatever the data center. There's that report that came out that they might be not doing as many data centers as announced. All these things are kind of falling together into the same space thematically. So there seems to be more of that now that actually kind of has a degree of coherence. And at the same time, the inflationary data. My thesis was always that an increase in housing activity would result in lower rents, and then it would result in home prices as they actually transact. People would lower the prices when the market starts going. Then you're going to start to get price cuts. There's a lot of evidence that was going to happen. The fact is it's not happening because we're not seeing the activity that we should be seeing, and that's not dragging down the prices, and therefore the expected disinflation from shelter is in question. And a lot of models were looking for that. I've been kind of looking at it, and it's something I think we have to realize. You start with certain sort of assumptions and certain kind of things that seem possible, but at the same time, when they don't happen and other things start to happen, you have to recognize that as well. So let's talk about Tesla and XPeng and Neo and Li Auto. This chart stunned me. I'll actually show this to you guys. I created it and I was like, wow, this is really, really something. So this is I have it hidden here. This shows XPEV with relative strength against Tesla. It has outperformed Tesla by 77 percentage points in the last 21 trading sessions. All right. So now we've talked about the migration of money away from American tech to Chinese tech. And if we look over here on our MT main, that's really a story that is emerging here. If we look on our industry ETFs in the last month, Chinese tech is the outperformer along with gold miners. Now, these are like the industries, and these are the spider funds, just so you know. That's how I have this organized. So it's interesting to see the relative strength in the Chinese tech names. And again, we have to realize DeepSeek has done well. There was just an article I saw now about the Chinese company Xiaomi coming out with some new kind of smartphone. Then if you also look in, and that's not exactly, well, it is kind of Chinese tech. When I'm talking about European car sales for Tesla, they were not good. And at the same time, the Chinese are entering the European market, and they're likely, to think about it, enter other markets. And I would just say over time, the thing that really, I think we have to focus on is going to be places like India and Indonesia. These areas have still emerging middle classes. And if you want to look where is the large demographic middle class growth in the next 10, kind of 15 years, the places where you're going to have the biggest just gross numbers of people entering and where incomes just overall are likely to be increasing. India, Indonesia, those maybe because they're such big countries, and they also are at that spot where there's still a lot of poverty crossing up into that next level. My view here is that we got to realize is that that's kind of what the growth engine is for some of these areas. And in some ways, I still think we have to realize is that some of these Chinese names are going to compete on an equal footing with Tesla and Apple in those markets, and they're coming in at lower price points. So I think they have the momentum. So I think we have to realize here is that this is something as we kind of look out and as investors look to allocate, there's actually a spot here where the Chinese technology has a potential narrative ahead of it. And I think that it's something people aren't looking at as much, but I think they're, when the data confirms it, when you get the deep seek, when you get things like this XPEV outperforming, where'd it go? When you get things like this and you look at some of the news that's been coming out, because what do we actually see with, was it, I'm trying to actually look here at some of the news. It was Lee, who was it? All right. So XPEV officially entered the British market. XPEV. My computer is really ailing here. They officially entered the British market on the 12th. Lee, LI, was lagging. And now it's come to life because now they're announcing a pure electric hybrid. So this is a company that is not pure electric hybrid, a pure electric. They traditionally did hybrids. Now they're doing pure electric. So this is another one that was kind of interesting. Meanwhile, Tesla has not been announcing this model that's supposed to come out in the first half, this low cost. They're going to have an economy model. So if you look at it right now, I think it's interesting to see this significant outperformance in the Chinese names. At the same time, Tesla has had one of its worst months in a long time. It's on pace for its biggest monthly drop since January of last year. It's, as of last night, the fourth worst performer in the S&P 500. It has dragged down consumer discretionaries. So we're basically seeing here, there seems to be a pretty, the data suggests that we are really seeing this shift to the Chinese names like we've talked about. And we are kind of seeing an increased sort of anxiety about the American situation because of valuations, because of the potential economic situation with the potentially stagflationary environment. So when people like Al Arian go out and say it on Twitter, it starts to pop up in other places. And now we might want to kind of see as we go into next week and we get ISM, manufacturing and services, which has price indexes built in, and as we get non-farm payrolls, and then is there a word of stagflation that emerges from the news media, from the narrative, from the analyst reports, and after that we have CPI, and then we have the Fed. So I think we have to realize here that we're in a spot here where the narrative could shift, the awareness could shift more toward a stagflationary kind of problematic environment. And look at the S&P now; it's kind of conforming to that. Let's look over here on our MTES again, and we're basically seeing the S&P. I mean, from my perspective here, it's like I said, we basically we got under that level that we should have held. And the problematic thing is we bounced at it once, we bounced at it twice, and the third time we went under it, and we couldn't even close above it on the daily. And so I don't think we did. Let's look again, but I don't think we managed to close above it on the daily. I don't want to go into that, but the thing is we didn't get a daily close above it. The 5 days under the 10-day, the 8-day exponentials under the 21-day exponential. MACD's falling. 9-day rate of change is now negative. RSI is inching down under 40. So all these sort of things following a false breakout with high valuations and this sort of stagflationary narrative emerging before us, as we get into a more significant chunk of news. We've been in this kind of dead zone, and we're going to start getting into that. So I think we have to be aware of it right now. And the thing I think it's important is I'm going to jump back to my concept of the volatility cycle, which is that we haven't really seen a lot of volatility for a while. And we could enter a period here of volatility, and that is when it can make sense to just kind of flip your brain toward S&P futures. Individual stocks can just become very tricky in that environment, messing around with things like that. And one of the doctrines or one of the principles we have in the volatility cycle is that when things get volatile, they get correlated, and it can be a lot simpler to just trade the indexes and stop messing around with individual names. So that's one of the things I wanted to talk about and just kind of highlight, is that we could be entering that environment here. This bull market, in my opinion, I really think it started in November of 2023. 3, and basically this environment i- is now like 16 months old. And that's a spot when, you know, it has more